Hello, this is Ron Climer. This is Ron Climer from Hendersonville, North Carolina. And I work for Keller Williams Realty, Mountain Partners on Main Street, right here in Hendersonville. And I just wrote a little article for my blog today, and I said to myself, I need to put this on video because a lot of people seem to be confused about qualifying for a mortgage. You know, you talk to a lot of expert types and they make this sound like it's so mysterious and everything. The truth is, it's not at all mysterious. What happens is this: if you want to buy a house, the mortgage company, they just want to know that you're going to pay them back. Does that seem fair enough? Now, if you're earning $3,000 a month as your gross income, well, it's a pretty good bet that you can't afford to make a $3,000 a month house payment. Does that make sense? And so what they have is they have a thing called income ratios. They're called income ratios. By the way, that's all of my contact information right there, but I'm going to take that down because I want to show you how these income ratios work, because it's not mysterious. It's just, it's simple. And I'm just going to use an example of a man and his wife that earns $6,000 a month. Now, by the way, if you're doing this with me, take your income. Don't take $6,000 a month, take your income. But I'm going to use an example of a man making $6,000 a month, him and his wife together. Before they pay taxes, before they pay union dues, before they pay anything, their gross income is $6,000 a month. Well, they have this thing called housing expense ratio. And what it is the ratio of how much of your income the mortgage company, the bank, feels like you can pledge to make your payment with. And what that number is basically, now this varies from place to place, but basically it's 28%. So you take 28% of your gross income, and that is $1,680 PITI. Now, if you're not familiar in real estate, PITI stands for principal, interest, taxes, and insurance. Because when you make your house payment, you have your mortgage payment to the mortgage company. That's the P&I. You got to have taxes. Well, let's say your taxes are $2,400 a year. Divide that by 12, they add $200 to your payment. And your insurance is $600 a year. Divide that by 12, they add $50 to your payment. Now, whether you make your payments PITI, some people do, some people don't, they always compute your ability to pay based on PITI because you have to pay your taxes and insurance. So $1,680 is the payment that this guy can qualify for. Now, that's simple, don't you think? But here's the deal. There's another thing, and that's called your total obligations ratio. Now, what your total obligations ratio are, we got this same guy making $6,000 a month. That's his gross income. Well, total obligations ratio are 36%. So the bank says you can only pledge 36% of your income to all of your debts. Your car payment, your truck payment, your motorcycle payment, your ATV payment, your Sears payment, your Kohl's payment. All those cannot exceed 36%. Well, do this math, and that comes to $2,160. So this person can pledge $2,160 to all their debts. Well, what happens to a lot of people, they got a big old $400 a month car payment, $400 a truck payment, $100 to Sears, $100 to Kohl, and this and that and the other. And what you do is you subtract your car payment, subtract your truck payment, subtract your Sears payment, subtract all those payments, And a lot of times the number at the bottom here is smaller than this number. And so whichever is the smallest is the one that determines it. Now this is not the only way for qualifying people, but this is a very basic way. It's a very basic way. FHA uses this, and now sometimes a lender might can sneak this up to 38 or 39 or 40%, but you need to ask yourself, do you really want to do that? And so that's how qualifying works. By the way, a big aggravation to a lot of buyers is they say, well, why does Mr. Realtor want me to be pre-qualified before I go out and even look at houses? Well, here's the reason. Let's say this is you. This is the payment you can afford. Well, you want to go look at $350,000 payments and you've got $30,000 to put down. Well, a $270,000 mortgage has a little bit bigger payment than that. And your realtor knows that. And so, and even if your realtor didn't care, he says, hey, I got plenty of time, let's go look. So sure enough, you find this $300,000 house that you like, you make an offer to buy it. Well, the listing agent, the seller, says, we need a letter from the bank stating that this guy has the financial wherewithal to do this. And so they won't even look at your offer until they see a pre-qualification letter. So I would suggest to anybody that's going out to look at houses, get yourself a pre-qualification letter from a local Hendersonville bank. We don't need the bank of the Yukon off the internet or something like that. You want to get a local mortgage company here in Hendersonville or North Carolina. You want to get a local lender that says this guy can buy a $200,000 house, $300,000 house, $400,000 house, whatever it is. So if I can help you, and by the way, let me put my information back up here if I could, and if I can help you, I'm Ron Climer. My email, ronclimer@yahoo.com, phone number 755-6996. I'm with Keller Williams right here on Main Street in beautiful downtown Hendersonville. I live in Tryon. I can help you with anything that you think you might want to buy, or better yet, if you got something you want to sell. I'm pretty sure I can tell you I won't be bringing any unqualified buyers to look at your house if you got it listed with me. So if I can help you, give me a call. Stay in touch.